Awesome. We are live. Hello and welcome to How to Invest. In today's live stream, we are going to be deep diving the company IREN, which I believe stands for Iris Energy. This company was started by some Australians, some Australian brothers to my understanding. We're going to do a bit more research. I watched a little bit of an interview the other day. I have a basic idea of what the company does, but I really wanted to dive into their financials and see maybe if we can get a little bit of a better story around this company and maybe model out some of their growth and what that could mean for their stock price. So we're going to start by just going through our spreadsheet, filling this all out. So let me make sure I pull up the chat here so I can see if anyone joins and asks any questions. And just mute that. Okay, perfect. And we will go ahead and switch to this screen. Perfect. So from my understanding, and we'll update this as we go, the story for IREN is it is a, let's see, we can have a little bit of, here we go. It's not letting me type. Okay. The story. So the story is a little bit different than the synopsis. So the story to me means like, where is this company going? What is this company building? So in the midst of a AI boom cycle, IREN is transitioning to a data center company for AI training and building AI factories. I like factories. That's kind of what how Jason Wong describes them, and I think it's probably a pretty accurate way to describe them. So just a little, I'll go over the synopsis next, and that will kind of be what they're doing now. So in the midst of an AI boom cycle, IREN is transitioning to a data center company for AI training and building AI factories. They are able to offer better prices due to using cheaper energy at custom built facilities. So this has to do a lot with their background as Bitcoin miners. They are really good at building Bitcoin mining facilities, and they usually are in very remote places where they're able to tap into really cheap electricity. I'm not a pro, or I don't understand Bitcoin mining a ton. I do, from the little bit of research from people who do understand Bitcoin mining, they are able to mine quite efficiently from what I can tell. They don't hodl the Bitcoin, they sell all the Bitcoin. But in the interview I watched, it sounded like the reason for that is because they're constantly trying to raise capital to continue to build out more mining facilities, and now they're going to start trying to build out some AI facilities. And so it doesn't make sense for them to hold the Bitcoin when they're already trying to raise capital. So it kind of looks bad. You're holding this asset on your balance sheet that you could be selling instead and be reinvesting the profits from selling that asset that you're mining to build more facilities. To basically, the way the CEO put it was he's doing it because he actually believes that it's going to bring the greatest shareholder returns. So he's doing what's best for the shareholders in his opinion. So we'll dive into that a bit today to see. He's not a Bitcoin treasury company. I know a lot of Bitcoin bulls would love for them to hold the Bitcoin, but that's not what the CEO is seeing. I don't even know the CEO's name. Let me see, so I can actually refer to him. IREN CEO. Let's see, Daniel Roberts, and I believe it's him and his brother. Okay, yeah, so it's Daniel and Will Roberts. So I watched an interview with Daniel the other day. Both handsome Aussie men, so, and they're both co-founders, so that's good. All right, so yeah, I watched the interview with Daniel, and he was saying, yeah, So, okay, let's go into the synopsis. So basically it is a IREN is a Bitcoin mining company slash, I guess, energy efficient compute company, because they basically want to have super efficient compute for whatever has the highest ROI for shareholders. So that is why they're transitioning away from Bitcoin to data centers. Daniel said in the interview that if Bitcoin jumps to 300,000 per Bitcoin, that they would probably refocus on Bitcoin because that's the best ROI on compute. So they're really just like an energy efficient compute company, and then they point that compute towards whatever has the best ROI. So but historically that's been Bitcoin. They're kind of classified as a Bitcoin mining company. So they are currently pointing their focus, sorry, this is a bit small, I know, towards AI data centers. Okay, let me get this a little bit bigger so it's not so tiny. Okay, let's perfect. Okay, hopefully you guys can actually see that now. All right, let's see if we can find IREN mission statement. So we're just going to go through, I actually haven't done this on stream before. We're just going to go through this spreadsheet and actually fill the whole thing out. I think that will be a bit more entertaining. I've kind of noticed that the viewer count doesn't really stick around when I'm just watching earnings calls, which is totally understandable. It's very boring, me just taking notes while listening to earnings calls. Probably earning calls that if you're interested in the company, you've already listened to, but I haven't because I'm researching the company for the first time. So I'm going to go ahead and fill out the data sheet, our master list, because I believe it's a bit more entertaining for you guys, a bit more engaging. So that's what we're going to be up to today. So, and I think this is filling out these like kind of columns, I think is super, super important to help build the story in your head. Kind of our investing philosophy here at How to Invest is very centered around story investing. So we want to know the founder's background. We want to know what the company believes in, what they're doing, really the future that they're trying to build. And if we believe that that's an exciting future and a future that other people are going to be excited about, then that's potentially a great investment, right? So we want the companies, we're growth investors, we want the companies that are actually building the future. And obviously we want to have a good return on those investments. So we take all of that story and then we turn that into the best approximation of like the potential return that we can do. So part of that is building the story though first. You have to be confident. You want to build conviction in the company. Because even obviously whatever prediction we make for stock price in the future will never be correct, but we want to be directionally correct. And the way to be the most directionally correct is to build that story in your head and to build the conviction in the company, or the lack of conviction. Maybe you start to build the story and you're like, I don't believe in the future they're building, the founder is an idiot or whatever, and that tells you a lot. So okay, let's see. All right, so this is basically a little bit along the lines of, I think is this the correct IREN? Okay, who are we? I don't think that's the correct Grupo IREN. I don't think that's the IREN that we are researching today. All right, we are the responsible way to power Bitcoin, AI, and beyond. I don't know if this is exactly their mission statement. We own and operate next generation data centers powered by 100% renewable energy. So that's really cool. Very green, very hip with the times for sure. We target regions where there are low cost, abundant, attractive renewable energy sources and where we can help solve energy market problems. So, okay. So they view themselves as more of an energy company than a compute company, I guess, which is very interesting. So maybe we should change their synopsis a little bit from like compute focus to just like, I'll put this in here. I think that helps us understand their story a bit more. So, okay, perfect. Compute company, currently pointing their focus towards AI. We target regions, but let's see, what's their mission? We are a responsible way to power Bitcoin, AI, and beyond. I guess that's We believe in technology can and will change the world for sure. Iris, early days, formerly known as Iris Energy. Okay, so they used to be called Iris Energy. Now they're just called IREN, kind of for short. Let's see. Our future. Continue to grow the business in a sustainable manner. Growth opportunities. Service. Growing demand for power-dense computing applications. Expand existing facilities. Develop new ones. Develop and operate new renewable energy. Leverage other platform opportunities. Green hydrogen. Parse strategic acquisitions. Okay, so I mean they're really trying to not box themselves in, which is really good. I think that gives the CEO Daniel and other co-founder Will a lot of opportunity to be very flexible with how they see they can push back or push forward the best shareholder returns. So okay, I think this is a pretty good approximation for their company's mission though. So paste this in here. We have the responsible way to power Bitcoin, AI, and beyond. We own and operate next generation data centers powered by 100% renewable energy. Okay, so products. They do Bitcoin mining. They do AI data centers. And they service basically energy intensive industries with renewable energy. Okay, very cool. Moat. All right, let's see. We probably will have to listen to their calls a little bit before we really get a better understanding of what their moat is. And the moats that they potentially can have. I just did a really good online course about potential moats. It was very, very helpful. So let me see if I can find my notes on that. I took it here in a notebook. So types of moats. A network effect. They don't really get any kind of network effect. So I don't think they technically have that moat as a Bitcoin. So the idea of a network effect is new users create value for existing users. So if they service another AI hyperscaler, the hyperscalers that they already service don't really get any kind of benefit. Data centers are a bit of a commodity. Switching costs, once you become a customer, is painful to switch. This is probably true. They probably do have some switching costs for these. I mean, the AI data centers don't even exist yet, though. So we'll just say perhaps some switching costs for AI data centers once they're built. They do have a little bit of switching costs in the sense that there are in the geographical area that they are. If someone is requiring energy, there's probably not a lot of other options in the area. But I don't know how much they're producing energy for consumers. I think they're mostly using the energy themselves to power things like Bitcoin. They do have low production costs from my understanding, so that would definitely be a moat. They can power these data centers with much cheaper electricity because of the way they source their electricity in very remote regions with lots of excess power. So that's definitely a moat. Lower production costs for sure. Intellectual assets. I don't know if they have much of this. I don't think really brand value, patents, or intellectual property really plays too much of a role into their business model. So I wouldn't say that's really a moat for them. A disruptive business model, counter positioning. I mean, they're following pretty typical business models. They are switching up the data center business model a little bit, but data centers are typically in the middle of cities or around population centers. So they are, disruptive business model by placing their data centers in remote parts of the countries, remote places. because they have it more in just America. They have data centers in Canada. They have data centers in Texas. They may even have some data centers in Australia. I'm not sure, actually. So business model. Let's see. This is mine and then sell Bitcoin by setting up remote data centers and powering them with cheap energy for lowest cost. So that's a pretty good. And then also same idea for AI factories. So I mean, it's a good business model for sure. I think it's very, very effective. Let me look up Daniel and Will's history a little bit to get a better idea. Will IREN. What's their last name? Roberts. Okay. Roberts. See if we can get some background on them. That would be really good. Might be some here as well. Let's see. About us. Who are we? I think that's pretty much where I am here. It's good to know who your founders are, previous experience, just to help continue to build conviction. So we'll see if we can read anything about him. So Will Roberts has 13 years of experience across resources, commodities, and real assets. Will was vice president of McCurry Group. Okay. So we'll definitely want to look up this company, understand what they did, see if we can get a market cap or a valuation on that company in the commodities and global markets division, and involved in debt financing and principal investments across mining projects, as well as managing FX and commodity. So that's foreign exchange. Will co-founded Macquarie's digital assets team. Okay, let's see if we can go to his LinkedIn and get any additional information. Oh my gosh, look how many notifications I have on here. I'm never on this. Okay, so he's the vice president of this group. He worked for Westpac, which I believe is a grocery store in Australia, and then Brookfield Multiplex Funds Finance Accountant. So we'll look some of those up as well. Let's look up this group real quick. Let's see. Is this a publicly traded company? Does it have a market cap? Oh, wow. Okay. So he worked at a very, very large public corporation, 87 billion. That's Australian dollars, though, which I think is about half US dollars. So AUD to USD. Yeah, okay. A bit more than that. So 87, so 57 billion US dollar company in Sydney, Australia. So, and what is this company? What does this company do? Let's see. Let's search up the wiki for this. Okay, so they are a multinational investment banking and financial services group. Investment banking division, Australia's top-ranked mergers and acquisitions advisor with more than 871 billion Australian dollars in assets under management. One of the world's largest infrastructure asset management. Okay, so I mean, this is like, if you're thinking about background for a CEO who like main job is to finance real asset build out, energy infrastructure, and all that kind of stuff, this is a fantastic background. Real world experience in the space. Let's see if we can get Will back up. What did he do here again? He was vice president of their commodities and global markets division, involved in debt financing. So they're doing a lot of debt financing at IREN to build out these data centers, principal investment, mining. I think this might be physically mining, not Bitcoin mining. There's a lot of mining in Australia. I know I lived there for 5-6 months. I tried to get a mining job, but they're very popular, but very, very lucrative. But I'm guessing this is physically mining because Australia does a lot of mining, and that's not Bitcoin mining. That's like mining of actual ores and stuff, managing foreign exchange and commodity price risk. So, I mean, this is a fantastic background. Co-founded the digital asset team. So there's probably some background in crypto there with the digital assets team as well. Okay, super interesting. So yeah, Will, the brother, seems like he has a lot of background in kind of investing, crypto, that kind of stuff with a really, really large multinational corporation from Australia. So that's really cool. let's see about Daniel. And I think this is kind of the main honcho. I think he's a little bit more of the face of the company. So Daniel has over 20 years of experience. Okay, wait, we need to Will Roberts. Background in investing in mining and digital at 57 billion dollar investment bank in Sydney. It's a little bit of a synopsis on him. He's the co-president. I'm not spelling president right. I wish there was autocorrect in Sheets. I'm so bad at spelling. I'll get there one day. One day when I'm older, I'll know how to spell someday. Okay, there we go. All right, he was the co-president, right? He was vice president. Okay, that's a bit different. Vice president of what exactly? I'll just group commodities global to market division involved in it. I'll just control copy this whole thing. It's a good synopsis of his background. Perfect. Okay. A couple line breaks. I don't know if you can do line breaking. Oh, there we go. Perfect. All right. So let's get Daniel's background. Across finance, infrastructure, and renewables. So that's really good because they use a lot of renewables at the current industry, current business. He previously exited as the second largest individual shareholder in infrastructure fund manager. Is this a company? Let's see. Palisades Investment Partners. Okay, so this is his exit. So he exited this company, Palisades Investment Partners. Also, let's see if we can get a market cap. I don't think this company's publicly traded. Palisades Investment Parties. In 2024, the company generated total revenue of 41 million. That's pretty impressive, actually. So he was the second largest shareholder in this. Let's see. The company has a market cap of 2.19 trillion. There's no way that's right. LP limited partnership. Stock holdings in Alphabet. So this company has a lot of stock in Google. Stop these pop-ups. It's a bit unclear. So Palisades, I mean, this market cap has to be the market cap for Google, right? 2.19 trillion. It's got to be the market cap of Google. Not Palisades, but it seems like they have quite a lot of revenue. They own quite a couple $1 million in Google, so it seems like a pretty successful company all around. And he was apparently the second largest shareholder in that company. billion in Australian dollars across 23 businesses. I'm not exactly sure what AUM means, but prior to that, he worked at the same capital group that Will worked at. Board of Jolt, a BlackRock-backed EV charging business where he is also the second largest individual shareholder. His Bitcoin journey. So it looks like he's on the board of another company as well. I don't know. I've never heard of Jolt before. It's probably a charging infrastructure company in Australia. You bought in high school, sold low, and then founded IREN. Very cool. So yeah, they both seem to have a really good background in a lot of the same things they're doing now at IREN, which is exactly what you want to see. Buy thesis. Well-versed founders with backgrounds in capital, investment, and energy, and digital assets. So, yeah. Cheap cheap energy that they can point at the highest ROI, return on investment for that energy. They also have a ton of compute. So, okay. Very, very cool. I would classify this as a fast grower. They are currently growing super, super fast. So, okay. That gives us a really good idea of this company's background. All right. So, we're going to get into some of their revenue growth now. Let me open up Macro Trends. This is the best website I've found, at least, for looking at historical information for companies. So back here in 2022, that's probably, they've only been public since then, so this data is only going to be from 2022 to 2024. So let's see, 2024. Is this quarters? Can I change this to quarterly trailing 12 months? Okay. So trailing 12 months for 2024, they had 285 million. 285 million in revenue. We want back to 2023. They had 107 million in revenue. Got something on my keyboard. There we go. Perfect. Let's see, 5-year average. This is not calculating right. Divided by 5. Okay. We can only go back one more year before this, and this year only has 2 quarters, so that's not very good. But we'll use it still. This was 63 million. Okay. 63 million in revenue. 5-year average. So this is not calculating right. So 151 million. I don't know really what the point of doing this 5-year average is, but oh well. And we want this to be a currency number. Round it. Okay. Analyst forward revenue growth rate. Let me close some of these tabs before it gets just like too crazy. Perfect. I don't think I need this open. I already have these two open. So we're going to go look at Yahoo Finance to see some of the analysts' expectations for their forward revenue growth rate percentage. Let's go to IREN. Getting a pop-up ad. Get out of here, pop-up ad. Oh, there we go. IREN. I believe this is the right company. It's a $16 stock price. Yeah, that's the right one. Okay. So we got IREN here. We want to go to analysis, and this will give us earnings revenue estimates. So let's see. Current year. So for current year, they're estimating, yeah, okay, so this is probably exactly where I pulled it from. 165%. That is some crazy growth. What is this company's valuation metrics? Because I believe it's profitable. What is PE? So its PE ratio is, it doesn't have a trailing PE ratio, but it's forecasted to have a forward of 197. So it looks like this company is just getting profitable, which honestly is really bullish. So they're still below IPO stock price. They have had quite a big run since the end of 2022. I'll pull the stock price so you can see it. So they have been running since their low in 2022, where they were trading at $1.25. But this company is growing crazy quick, having 165% revenue growth rate. I mean, This is like way faster than even like Palantir growth rates. So it's going to be a really interesting AI play. All right, and then the year after, 73% growth rate in revenue for 1 year. Okay, so forward revenue growth rate 5-year average estimate. They're growing. We'll have to listen to the earnings call before we can really start to fill that out. I'm not really aware of their track record of execution. Let's see if... I don't think you can see forecast and beats on here. Let's see if there's any... Let's check out the financials. Let's see what their operating income is. Okay, so they have been... And this is all in thousands, so... They lost 48 million, lost 27 million, and it sounds like they'll get to profitability this year. So flipping from unprofitable to profitable is super bullish. There's usually pretty decent run up, and you see the PE fall super quickly because you have kind of your overhead costs, and then you have your incremental costs. And once your revenue, especially with your revenue growing like that fast, if a lot of your base costs stay the same and you're just increasing your marginal cost, 100% increase in revenue, you could see like 1,000% increase in earnings. So you can get some crazy things happening like this. So even though it's at a 200 PE, you could see that fall really quickly. We'll have to get a little bit more information on that to really predict that out. But for now, let's see if that theory that I had just presented is the actual case for their earnings, if their earnings are about to skyrocket. All right. Yeah, track record of execution. Can't really fill that out yet. Where and how will it grow? AI data centers. Build out. And I think they just got one of their Bitcoin mining facilities online, and they're also scaling that out. So they're not even seeing all the revenue and earnings from their current infrastructure that they just finished. Analyst forward. I think, isn't this not analyst? Analyst forward growth rate. Analyst earnings. Okay, so that's the earnings. Let's see. Let's see if analysts have anything on earnings. Because again, this could be growing way faster. Earnings estimate. Yeah, they don't give a percentage for the earnings estimate growth, but they're predicting 6 cents of earnings per share and then 28 earnings per share. So, I mean, going from 6 to 28, I mean, what is that in growth? 28 divided by 6. I mean, that's 466% growth earnings. So, that's pretty crazy. That's what I'm saying, like, where revenue grows, earnings can just like grow so much faster, right? So 100% growth would be a doubling, and they're going to grow earnings 466%. So you could see that PE, forward PE of 200 drop super quick. What's up, bro? How you doing? Good to see you in the chat. We can't really do our forward earnings until we listen to a bit more. Yeah, and we need to listen to the earnings call. How will they achieve earnings? Scaling up Bitcoin mining, pushing efficiency. Again, sorry for the bad spelling. And then building out AI factories. Yeah, cool. Are they reducing costs? Yes, they're continuing to reduce costs. Are they raising prices? I mean, it doesn't really apply to them. But I guess raising prices could be Bitcoin's prices raising. So in a sense, that could definitely be true. They're entering new markets. They are indeed. They're switching from, and they're potentially producing more Bitcoin as well. But yeah, they're going to AI data centers. Close underperforming parts of the business. False. Now they're going to keep going. Okay, we got most of this filled out already. Let's go ahead and make sure that they're filled out correctly. So We want trailing 12 months total revenue is actually more than this now. So, oh, this is referencing revenue somewhere else. Let's see where this revenue reference is happening and fill that out. CH. Okay, so we can go this way in the spreadsheet. CH. Revenue trailing 12 months. Okay, so this is greater now. So they increased revenue from 283, and I guess this would probably be Q4 trailing 12 month to now. See, they're going so fast, dude. This company is like a hyper growth beast, dude. So that's really good. Yeah, I mean, we'll just kind of round this up, not to be crazy exact. So okay, go back down this way. All right, so that revenue is filled out. So this is kind of the forecasting, which I can't really do at the moment, just because I haven't listened to the earnings call yet. I don't know what the management's guidance is, so we'll go ahead and skip past here. We'll fill this all out once I listen to the earnings call, which we will do here in a moment. So, all right, enterprise value. Let's look at the balance sheet. This is super important. Total. Let's see, total liabilities, net minority interest. I'm not really sure what net minority interest means. Total assets, total liabilities, net. I think that's already what we have inputted here. Total assets, yeah, that's already right. So, I mean, oh my gosh, you're getting 100 million, 100,000 million, yeah, this is a tiny market cap. So enterprise value is a much better way of looking at the price you're actually paying. Let's see, what's net assets, NAV. So 100,000 million, they have $1 billion in net assets. That's crazy. So this company is very financially secure, which is really good to see. You know, you love to see a ton of assets on the balance sheet. You know, there's no risk of this company going bankrupt. So that is really good. Price to book ratio, yeah, and then the enterprise value compared to the market cap of this company. Market cap $3.78 billion, but they have $1 billion on the balance sheet, so you're really only paying, you know, $2.6 billion because you have $1 billion in shareholder equity. So that's really excellent. Alrighty, so price to book, revenue trailing 12 months. Why is this different? Oh, that's what I just updated. Okay. Revenue note, no really notes on revenue. Price to sales, so it's not a crazy price to sales for how fast they're growing their sales, so that is pretty incredible. They are still losing money at this time, but it seems like they will become profitable this year, which is really good. So this company is going to be flipping to profitability really soon. Net profit margin obviously negative, losing money. Price to earnings, you can't really calculate that until it is positive. Why undervalued? I mean, I think they're undervalued because they're hyperscaling, and I mean they're going to grow into this valuation super fast, growth. I mean the 200 forward PE. I mean when you're growing earnings, we just calculated it out. They're growing earnings at like 400% plus. I mean, you're just going to see the forward PE absolutely collapse as you go forward. Impact on long term, the undervaluation, no, definitely not. Discount calculate because again they don't have earnings. Enterprise value to revenue growth, that is a really low. So we can look at EVR to RG here. So this is a metric of the enterprise value to their revenue, to their how fast they're growing revenue. So we have a bunch of companies here. We have Hims, Lemonade, Root, Hippo. So IREN over here at a 0.045 is literally one of the cheapest on the sheet. There's only a few companies that are cheaper. You have BioStem, SMCI, Oscar is looking really cheap on this. Hippo also looking really cheap, but you have really great companies that like Lemonade, Hims, obviously Tesla, that are looking way more expensive in terms of their enterprise value to their revenue to the revenue growth metric. So this is a really good metric to look at, kind of compare at different companies. Rocket Lab over here, another retail favorite, also very, very expensive comparative to IREN. So IREN's looking really cheap and like a really good company. So that's really interesting to look at. All right, so we'll go back here. Yeah, really low. Analyst. So the analyst is actually even lower than what we have inputted right now, because I think our forward revenue growth is like 5%. I'm going to change that after we listen to the earnings call again. Wow. Gross margin. That is really, really strong. Let me double check if that is correct. If that's actually their gross margin, that is fantastic. Let's see if we can see margins. Gross margins. Wow. That is really, I mean, I don't think this is calculating correctly. Revenue, gross profit. I mean, this is, I mean, I guess if they build out the asset and they don't have to count any of the operational costs against the cost of production, yeah, I mean, gross margin, I guess, could be 100%. But I mean, there is marginal cost for electricity. So, you know, something's not completely accurate here. I guess maybe just how they account for things is a bit interesting. I'd be more prone to accept this calculation here, gross profit, as let's see, CT22 CT. So CT. Okay, so this is gross profit divided by revenue. But I don't think we probably have the updated gross profit amount. So let's see if we can find trailing 12 months gross profit, income statement, gross profit. Okay, yeah, we need to update gross profit here to get a more accurate number. So gross profit 340. So this will give us a better idea of what is their gross profit percentage. So wow, yeah, they have a really good gross profit, 91%. This is excellent. I mean, this is fantastic margins right there, 91%. If they can get this to profitability and keep their operational expenses more so flat, you know, while managing or lowering their marginal expenses, their operational, cost of production, that would be fantastic. But yeah, cost of production is really low. If they can keep their operational expenses low, you'll see a lot of this gross profit drop to the bottom line. You could see this company become hyper profitable. So that is really incredible to see. And this is something to keep a note for this one, right? Like you see over here, SMCI. This is saying that SMCI is about 4 times cheaper than IREN right now based on their growth. But the problem with SMCI is their margins are razor thin. They do not have great margins like we're seeing with IREN. So I don't really love these super, super low margin, businesses like SMCI. They're a hardware manufacturer, whereas IREN is a digital asset manufacturer. They're they're going to be manufacturing AI tokens, and they're going to be manufacturing Bitcoin. So both the things they're manufacturing are digital assets, which have way higher margins. So when I compare a business to SMCI, where it looks cheaper, I would still pick IREN over SMCI for a couple reasons. One, the market cap's way lower, so there's a lot more upside, and then also just way better margins. And then you could see something crazy like, if we get a really big bull run for Bitcoin, that's just all going to go to like IREN's bottom line. Like it's going to be absolutely crazy. You could see Bitcoin triple from 100,000 to 300,000. Revenue and earnings for IREN just shoots up exponentially. So, and I think the long-term manufacturing of tokens is going to be a lot more stable of an industry than SMCI's data centers, which is a cyclical industry. So like just comparing SMCI to IREN in those couple of ways, I would much prefer IREN from what I'm seeing already to SMCI, just like a much more stable business model. Bitcoin's price fluctuates, Bitcoin's price is pretty stable. From my understanding, it's actually becoming less volatile than the S&P 500. So that's really, really good. And then also, I just think if they're building out these inference data centers for AI, that's just also just going to continue to scale with consumer demand for AI, which I think is just going to keep going. Whereas like, SMCI is building these data centers, but we really don't know if the data center demand is going to scale linearly with consumer demand. Whereas we know inference is going to scale linearly with consumer demand. So I just think that's a way, way better business model that IREN has over SMCI and is also super, super inexpensive. So, okay, we'll keep going here. Total addressable market. Oh my goodness. Okay, we're going to have to pull up Perplexity for this because I do not know the answer to this. By the way, guys, Perplexity Finance, not sponsored at all, but a fantastic tool when you're doing, research on stocks. I highly recommend it. So, all right, we're going to search up what is the TAM for AI factories, AI inference. Today, 5 years from now, 10 years, and 20 years. Get a little bit of an idea of what our total addressable market looks like. And obviously this is the market that they're going after. Oh my gosh. Let's see. Projected multi-trillion USD potential by 20 years from now. So projected by 2035 to be a $613 billion TAM, and this is for AI inference. So the total addressable market for AI inference is rapidly expanding, driven by the proliferation of generative AI, large language models. Excuse me. You get some water here. All right. Oh, very tasty. I love putting like lemons and pineapple in my water. Just makes it a little bit more tasty. Okay. So AI inference, yeah, we already read that. Increasing integration of AI into enterprise and consumer applications. Below is a summary of the TAM at key milestones. So, okay. I'm just going to take this, see if I can control copy this whole thing into this cell here. Perfect. Yeah, 15 to 23 trillion. I mean, if this is actually the TAM these things are going to go to, maybe I'm super wrong about SMCI. Let me move this up to here. I mean, 100,000 million billion. Yeah, let me replace that with this. Oh my gosh, that looks terrible. 2030. 20. That's all right. I guess that's 20% CAGR for AI inference. Let's see. So we can get this. I know we're pivoting a little bit to SMCI here. Just give me a moment. Having some trouble for AI inference. I mean, I'd love to be able to. Is there a way to, line break inside of a cell? This is annoying. Oh, there we go. Just control. Perfect. So this is for AI inference. I mean, they're more in data centers though. So it's like the problem again with SMCI is like compute is just getting more and more efficient. Yeah, I can't put that there. Because, as compute continues to get more and more efficient, the need for new data centers might decrease substantially. And so as the need for new AI data centers decreases, well, there goes SMCI's forward revenue growth. They'll have to replace the old data centers. So like I think the revenue probably won't like just collapse completely, but you could totally address this massive market for AI inference with just more and more efficient data centers, not necessarily more and more new data centers, that's where SMCI gets a lot of their revenue growth, I should say, because data centers, from my understanding, have to be replaced about every 5-7 years is kind of the lifetime of a data center. So all the data centers that are being built, like, that will be reoccurring revenue for SMCI to replace those data centers every couple of years. But that's kind of just like an operating baseline. Data centers are a bit of a commodity in terms of building them out. The thing that isn't commoditized is like the GPUs and the CPUs and stuff, and the memory and the RAM, which that's more in like Micron Technologies realm, NVIDIA's realm, AMD's. Just the actual building out the data centers. There's a ton of companies that do that. Dell does that. SMCI does that. Lenovo builds out. So there's a ton of companies, and it just these these data center build outs for these kind of builders have razor thin margins. So, and it's not any kind of recurring revenue. It's very cyclical with the demand for data centers. So it's just really kind of a business model that I'm not super stoked on. I do think SMCI has a lot of growth in the future though. But okay, let's refocus on IREN because that's where we're here today. So industry growth rate. Did it say a CAGR? CAGR of 20%. Yeah, I think that's probably pretty accurate. And we probably should know the Bitcoin CAGR as well. So 20% CAGR, and that's compound annual growth rate for AI factories. And again, AI factories are these inference factories that create tokens. Let's see, Bitcoin CAGR. Let's see, we can probably just do a Google Bitcoin CAGR last 10 years. Okay. Wow. Bitcoin is running last 10 years, 83%. Wow, that is crazy. That's a bit high. I don't think it's going to continue growing that fast. I'm going to take the 5-year here. Bitcoin CAGR. Bitcoin, we'll say a 60% CAGR. So, you know, they can keep the exact same mining infrastructure that they already have built, continuing to mine, and the revenue from those miners will just continue to grow at the growth rate of, you know, Bitcoin going up. So that is quite incredible. They literally don't have to do anything. Eventually, you know, these Bitcoin miners do age and they do become, you know, old, and you have to replace them. I think they kind of have the same life span of a data center, about 5 to 7 years. So yeah, very, very interesting. Okay, comparable companies. There's quite a lot. I think Mara is one Bitcoin miner. They hold their Bitcoin though. I could probably just look up a list of Bitcoin miners. I'm just doing these searches off screen, guys, for some privacy. But I'll pull them over as soon as I finish. So Marathon, there's IREN. Okay, so Mara isn't actually on this list. I do believe they mine Bitcoin though. All right. Oh, it's Marathon. Okay, yeah. So I got Core Scientific. Core. Let's just put their ticker symbols. Otherwise, we're gonna be here forever. Riot. Clean Spark. Okay, and what is their competitive edge? And I guess if they're going into AI data centers, let's see, data center companies. They're also going to be competing with these companies in a way, but not really. A list of these companies. The thing is, it's just like as this like industry grows, like there doesn't have to be just one winner. Like all of these companies can do super well. Yeah, I mean, these are Bitcoin miners. And then, okay, we finally learned how to do this. Control. All right. Data centers. We have like Microsoft, AWS, which is Amazon. Google has cloud centers, data centers. I think it's like CoreWeave or something, right? CoreWeave is one of these as well. Again, I don't think this is super important. Like, I'm not sure about CoreWeave, but whatever. Competitive edge, cheap energy, and management that is willing to pivot for the highest ROI use of energy. I mean, that is a real competitive edge though. Like management diff is like a real thing. If you have a good management team, like you can sleep so easy at night no matter what happens. You know, management team that's just on top of it, constantly looking out for shareholders. You know, that's what you want to see. Damn, my coffee is cold. That's unfortunate. Okay. Industry average mature market caps. Let's go back. Let's get the industry average market cap for these miners, Bitcoin miners. Industry average Bitcoin miner market cap. What is this? Yeah, market cap. I mean, this is like not super useful because as these companies grow, there's really not a limit to the market cap that it can get. As these total addressable markets grow, all of the market caps are going to continue to grow. Like, there isn't a top, which is, I think, maybe a little bit of an argument for removing this from the sheet, but I mean, right now it's not too bad. Bitcoin average mining cost. No, that's not what I want. By market cap. Okay, so Mara is a 6 billion, CoreWeave's 5, Riot's 4, IREN's 4. That's a bit out of date because it is currently lower. CleanSpark's 3, 830 billion. So the top 10 between 2 and 6. So you just split the difference. It's 4 billion if you took like the median. It's a little bit weighted heavier towards the less expensive side. Like 5 through 10 are all under 4, but maybe 3.5 billion. I could actually calculate this out, but I don't think it's that important. 3.5 bill. So it means IREN's market cap's a little bit below the average again, and if you look at enterprise value, it's about at average. It's at the average basically. Valuation multiples. So this is something I care about a bit more. So industry average Bitcoin miner PE ratio. So this is a bit more important because it's going to get pulled back to this. The average PE ratio is minus 12.6% because probably a lot of these Bitcoin miners are not profitable yet. That is too funny. And I think there's some issues with like how they have to report the Bitcoin that they mine and sell. Like they're doing it for profit, or probably a lot of these hodl the Bitcoin too, so they're like not really producing any revenue. Yeah. This said back here that it was 22 average PE, but I don't know if that's correct. Let's see. Bitcoin mining PE ratio 2.01. Yeah, I mean, for this again, it's just like if the company's growing super fast, like earning super fast, like who cares what its peers are? The market's gonna price in super rapid growth. I mean, like the PE ratio can at least be forward earnings growth ratio, and the forward earnings growth on this company for 2026 or 2027 or whatever we calculated is like over 400%. So like it could easily have a 400 PE ratio if it's growing at earnings at 400% a year. Obviously, I don't think that's super sustainable for a long time, but it could definitely be for a little bit. So we'll still feel this out. It seems like it's pretty low or negative even. Metals and mining. No, we want Bitcoin mining. I mean, this says it's bit 12. So does it even have IREN on here? Yeah, it does. All right. Well, we'll put it in. It doesn't really actually affect what IREN's PE could go to, but whatever. Bull case would be Bitcoin price raises, management executes, AI factory build flawlessly, and continue to build more facilities. Bear case would be Bitcoin price drops. That would be really bad for them. Fail at building AI factory. I mean, these are definitely the risks. But this is again where you have to build your belief in management, right? Do you actually believe that management's going to fail at building this AI factory when they've consistently shown that they're able to build super, super profitable Bitcoin factories? I mean, I would find it highly unlikely that they fail at building basically a data center when they've been building data centers. Like, they know how to install computers, they know how to install the energy. Like, that's your two basic ingredients. Instead of, you know, setting up rigs that are made and optimized for Bitcoin mining, you're installing rigs that are built, or server racks that are built and optimized for AI inference. So, and most of the time you're working with a vendor anyways. You get a professional like SMCI to come in, or Dell or something, to build out your center. So it's like, you just have to have the right capital, you have to be able to get the investment, which they've shown time and time they can do, and they've continued to show that they can execute. So I find this highly unlikely. The more likely bear case is that, you know, Bitcoin price drops. So upcoming catalysts. I think we are in a little bit of a bull market, and we could definitely see a Bitcoin run. So, you know, Bitcoin run, maybe, and then upcoming catalyst, AI data center, AI factories, like bull run as well. And this one is I'm quite a bit more certain about. You know, the AI factory bull run, I'm a lot more certain about. So, okay, current short interest. Let's see if there's much current short interest in IREN. This is really important, guys. I would not overlook short interest, because I mean, if the stock actually goes up, this is like guaranteed buying power. Like, these shorts have to eventually cover. So like, if the stock starts to run, you're gonna see all of these shorts cover, and then it's gonna push the price up even more, because, you know, they're gonna, you know, people with the greatest shorts, the lowest shorts, they're gonna like start freaking out. You know, the lowest stock price shorts, and they're going to start covering first, and then the people above them, they're going to cover because the stock price keeps running up. So like, this is some built up, you know, demand really, if you think the stock price is going to run up, you know, overall. So 12% shorted, so that's actually pretty good. It's not the craziest we've seen. Like right now, Lemonade is like 30% shorted, and they're gonna reach like EBITDA profitability in 2027. So you could see a lot of short covering for Lemonade stock. Lemonade's one of the companies we're the most bullish on right now. So, all right, we made it to the end of our spreadsheet. So innovative. I would say they're somewhat innovative. I mean, they're hopping on the AI inference train. They've been able to kind of build a new business model in terms of these Bitcoin miners building their own energy production in these really remote. Are they a generational leader? They're not really the biggest, and they're not. Yeah, it's hard to say for sure they're a generational leader. I mean, they're a little bit just hopping on different bagwagons, so I'm not really saying they're leading anywhere. They do have really good fundamentals. I love to see a good, strong balance sheet, and a really solid growth rate, obviously, and like really good gross margins. The only thing, obviously, we're not seeing yet is earnings, but I think they have a very clear path to profitability. They are founder run. We do love our founders. You know, when they bring in these other CEOs and stuff, they don't really care about casting a vision. They just care about, you know, reaching their compensation package or whatever. So more than 10% insider owned. Let's see. How much does Will and is it Daniel or David? I forget. Daniel Roberts own of IREN. Okay. Let's see. Let's see what we got here. Got short interest. Close these out. Yeah, these are both pretty useful still. Okay, IREN, the brothers cleaning up. IREN Limited. Let's just search IREN insider ownership. Let's see if we can get any information on owners and shareholders, institutional ownership. Let's see if we can get any information here. Okay, IREN Limited has 221 institutional owners. I really want to know about the brothers' ownership. The share price was that. Fund sentiment score. This is not at all what we want. Officials, directors, and any beneficiary owners of more than 10%. Number of open market buys. Number of shares bought. Okay, this is Not really. I mean, okay, so we have Alfred Michael, director, making a was that acquisition? So he making a buy there. Non-open market. This is just the beginning of this month. So there is insider buying, which is really good. Okay, so that looks like this. We could say yes to insider buying because you have a director, an officer, and another director all making buys of stock on, and this is for IREN, right? Yeah, IREN insider activity. So that's really good. I mean, we love to see, like, that's super bullish, right? These are people at the company every single day, and they're actively buying the stock. Means like they're definitely thinking it's underpriced right now, from what they're seeing on the inside. So that's definitely a very bullish signal. I'm just going to ask Perplexity, how much of the company does do the co-founders of IREN own? Guys, you got to use AI. AI makes your life so much easier. You can just do so much researching. 5 million ordinary shares. Collectively hold about 2.41% of IREN's outstanding equity. Wow, they do not own very much. Public data shows co-founders each hold roughly 1.86% ownership, individually valued at around 75 million each. I mean, I would love to see them own more than that, but I'm guessing with them owning about 2.5%, probably a bunch of these other people own a decent percentage. I'm just going to say yes because they do own probably all the insiders combined, probably close to 10%. What percentage of the company is insider owned? Let's see if Perplexity can answer that. Maybe a bit harder for it to find. Insider ownership, institutions. I mean, so it's not super insider owned. I think it's close enough for me to say yes. I mean, basically what you want to know is, like, are the incentives of the management in line with shareholders? And the easiest way to see if it's in line with shareholders is if they actually own the stock themselves, right? So I think that's enough to say yeah. Is it undervalued? Most definitely true. It is definitely seem very, and I think it's likely that you could get a 30% at least for a couple of years. Coma test, I think so. We can more definitively answer that question once we listen to the earnings call, which we will do here in a second. Coma test is basically, would I want to own the stock if I went into a coma for the next 10 years? Would I be certain that when I woke up, the company would be worth more than what it's worth now, and not have gone bankrupt, obviously. So I think it definitely, so that's a pretty good checklist score of 80. It's pretty high, so you can compare that to SMCI, which has a score of 40, MU 50, HIMS of 90, and Lemonade of 90. I don't know why we haven't done it for Tesla. Yeah, let's quickly run this for Tesla real quick. Innovated, very, very true. Generational leader, true. They are leading the EV market. They have great balance sheets. Founder run, yep. More than 10 insider owned. I believe Elon owns quite a bit. Disrupting, they are very disruptive. I think they will definitely return at least close to 30% a year. They are not currently undervalued whatsoever. I'm not sure if anyone is currently buying shares. It's quite expensive, so you could probably more likely you'll see Elon selling shares at this price, not necessarily buying. Coma test, yes, I'd be super happy to own this company for the next 10 years. So, yeah, 80% score there, so that's very good. All right, let's go back to IREN. All right, so the last thing to do here, guys, is come back over to our kind of forecasting section of the spreadsheet, which I call my Formula One, after, we love Formula One racing, so it's just a cool name. So this is the part where viewership's going to drop because we're going to watch an earnings call. I know you guys typically don't love to stick around for this. This is a long one. We'll put it on a bit faster speed. Sorry I can't just skip the earnings call. I know you guys probably aren't too much more excited, not super excited about listening to an earnings call. You'd much rather see me, do this research. I think it is much more engaging. So I do understand, but for my own purpose, the point of these deep dives is I was doing this research already anyways, and I would just decided, hey, why don't I live stream it? And if people want to join and learn, they can come and watch and learn with me. I'm going to open up my notes and take some notes on this earnings call. So You guys feel free to stick around if you want. We're going to listen to it on 1.5 speed, so it's going to take about 45 minutes to get through this. And then we're going to forecast it out. So maybe you guys just want to come back in 45 minutes to see me kind of forecast this out. That's totally fine. I understand. But I highly recommend, if you guys are serious about investing, to listen to earnings calls. I mean, this is the best way to hear from the founders what they are thinking and all that good stuff. So we're going to go ahead and play. I'm going to mute my mic just so we can hear the call more clearly. You'll be able to see me taking notes, and I also need to blow my nose, so I'll also be muting for that reason. So all right, guys, if you have any questions, you could drop them in the chat, and I'll pause the earnings call, all that good stuff, and then try to answer them. So okay, I'm gonna mute, and we're gonna get started with this earnings call.
Bye. Welcome to the IREN Q3 FY25 results conference call. At this time, all participants are in a listen-only mode. Please be advised that today's conference is being recorded. After the speaker's presentation, there will be a question and answer session. To ask a question, please press star 11 on your telephone and wait for your name to be announced. To withdraw your question, please press star 11 again. I would now like to hand the conference over to your speaker today, Mike Power, Director, Investor Relations.
Thank you, Josh. Good afternoon and welcome to IREN's third quarter FY25 results presentation. My name is Mike Power, Director of Investor Relations, and with me on the call today are Daniel Roberts, Co-founder and Co-CEO, Belinda Nucifora, CFO, and Kent Draper, Chief Commercial Officer. Before we begin, please note this call is being webcast live with an accompanying presentation. For those that have dialed in via phone, you can elect to ask a question via the moderator after our presentation. I would like to remind you that certain statements that we make during the conference call may constitute forward-looking statements, and IREN cautions listeners that forward-looking information and statements are based on certain assumptions and risk factors that could cause actual results to differ materially from the expectations of the company. Listeners should not place undue reliance on forward-looking information or statements. Please refer to the disclaimer on slide 2 of the accompanying presentation for more information. Thank you, and I will turn the call over to Dan Roberts.
Thanks, Mike. Good afternoon, everyone, and thank you for joining IREN's third quarter FY25 earnings call. I'm Daniel Roberts, co-founder, co-CEO of IREN, and today we will provide an update on our financial results for the quarter ended 31 March 2025, along with some operational highlights and some strategic updates from both our Bitcoin mining business and our AI infrastructure vertical. We'll then end the call with Q&A. So, starting with the highlights. Q3 was another strong quarter, operationally and financially. We delivered our second consecutive quarter of profit after tax, where we posted 24 million in net profit. This reflects a 28% growth quarter on quarter. Revenue then hit a record $148 million for the quarter, driven by growth in both our Bitcoin mining and our AI cloud segments. EBITDA came in at just under $83 million, also a record for us. Operationally, we continued our cadence of delivering 50 megawatts every month of data centers with the energization of Childress Phase 4. And during the quarter, we averaged 29.4 exahash of operating mining capacity, which represents a nearly 5x uplift year on year. So these results reinforce both the earnings power of our growing data center platform, along with the strength of our procurement engineering, construction, mining, and AI teams, who simply continue to execute. We anticipate this earnings momentum to continue into fiscal Q4 as we further progress on our key growth initiatives, which I'll now come on to. So looking forward, our strategy is anchored across value-accretive investments in both Bitcoin mining and AI infrastructure. On Bitcoin mining, we're on track to reach 50 exahash of installed capacity by June 30. That milestone represents a 4x increase from only 10 exahash in June last year and cements us as one of the world's largest and, importantly, lowest cost Bitcoin producers globally. But we're pausing further mining expansion at that point. That decision is deliberate. While mining remains highly profitable, we see more compelling shareholder value creation in AI infrastructure, and we want to be disciplined in capital allocation. In AI cloud, momentum continues. Revenues are increasing, underpinned by new contracts and customer retention. Our GPU fleet has been running at or near full utilization, with hardware level margins north of 95%. Kent will speak to this more shortly. In our AI data centers vertical, we're advancing two significant build-outs. Horizon 1, a 50 megawatt liquid cooled data center targeting Q4 2025 delivery. It's been designed and built for next generation AI workloads, supporting 200 kilowatt racks, which is around 20 times the rack density of traditional data centers. Again, we'll talk a little bit more to rack density later in the presentation. The second significant build out is Sweetwater, our 2 gigawatt flagship data center hub in West Texas. 1,400 megawatts at Sweetwater 1 is on track for energization in less than a year now, April 2026. The power is contracted, long lead equipment is secured, and site preparation and construction is underway. Finally, a few notes on funding and structure. So first, we continue to practice disciplined capital allocation, particularly in the face of broader market volatility like we've seen over the past few months. Our decision to pause on further mining capex is a good example of this discipline in action. We've also engaged advisors across multiple debt financing work streams. Discussions are active and we expect execution in the coming months as markets continue to stabilise. And finally, as previously noted, we will be transitioning to a US domestic issuer status from the 1st of July this year. That will align our reporting with US GAAP and reflect our increased US asset footprint along with the increased US investor base. So in summary, record performance this quarter, consecutive profitability, near-term milestones all on track, and clearly a capital discipline lens as we focus on high return infrastructure growth and value creation for shareholders in the AI space going forward. So to talk a little bit about Bitcoin mining. This slide speaks to the performance both in absolute financial terms and in efficiency, especially in our mining segment. What we're showing here is not just growth, but how we're executing well across multiple key operating and financial metrics. Despite macro headwinds, we're maintaining margins, we're scaling, and we're using operating cash flow to help fund our growth in the AI vertical. So let's start with the headline figures. We averaged 29.4 exahash in operating hash rate this quarter. That's up 30% from second quarter and is driven by the continued build out at our Childress site and the deployment of new generation hardware. What we've also seen is 326% year-on-year hash rate growth against only a 40% increase in network difficulty, reinforcing that we're not just growing, we're outpacing the industry and we're growing our market share. All of this feeds directly into revenue and earnings growth. We continue to lead the sector on efficiency. Our fleet level efficiency remains best in class at 15 joules per terahash. Our power costs averaged 3.3 cents per kilowatt hour at Childress last quarter and are among the lowest of any scaled miner globally. They're assisted by our energy market intelligence and software-driven optimization during price spikes or curtailment events. So all of this translates to strong operational leverage. And as you can see, as we've continued to add scale, our unit economics hold up and even improve in some cases. But perhaps just as important as this margin is how we fund growth from this point. So as many of you will know on this call, we've made a deliberate choice to support our growth, including the growth in AI, using cash flows from daily Bitcoin liquidation, rather than raising dilutive equity unnecessarily. On the top right, you can see what all of this efficiency, all of this profitability looks like in different metrics. So our all-in hash cost was $23 per petahash per day versus an average hash price or revenue of 54%, representing over a 50% gross margin, even on a fully loaded cost basis, which includes all indirect, direct OPEX, all in. To look at it a different way, on a per Bitcoin basis, our all-in cash cost, direct, indirect costs, all in was $41,000, as compared to $93,000 in realized revenue per Bitcoin mined this quarter. And again, realized, we liquidated, we achieved an actual price of $93,000 against an actual all-in cost of $41,000. So that's gross profit per Bitcoin of roughly $52,000 for the quarter, locked in cash. These margins are top tier clearly in the industry and also include all the cash costs for our AI business vertical. So they give us a strong buffer in the face of network or price volatility and give us a great platform to scale further from this point onwards, particularly noting that we had an average of 29.4 exahash last quarter, and we are within weeks of hitting 50 exahash. So exciting times. So if we turn our mind to the financials along the bottom, revenue grew from roughly $120 million in Q2 to $148 million in Q3, up 24%. Adjusted EBITDA from $62 million to $83 million. And on a statutory basis, EBITDA also rose 32% to $82.7 million. Finally, profit after tax, we saw an increase of 28% from a profit after tax last quarter of $18.9 million to a profit after tax this quarter of $24.2 million. So these results, they're not just about growth, they're about quality of earnings. We're expanding while keeping costs maintained and margins pretty resilient. So we're excited about the expansion ahead as we round out from what you've seen here as an average of 29.4 exahash to hitting 50 exahash in the next few weeks. So in summary, we're operating efficiently, profitably. We're utilizing operating cash flows to support funding our next phase of growth as we scale AI infrastructure. On to 50 exahash. So now to talk about our progress towards that key near-term milestone, which I've mentioned a couple of times, achieving 50 exahash of installed Bitcoin mining capacity by the end of June. It also highlights how this sets us up, again, as I mentioned earlier, as one of the largest and lowest cost miners globally, with substantial free cash flow available to support our AI strategy going forward. So as of April 16th, 2025, we reached 40 exahash of installed capacity. What's really interesting is that's up from just one exahash in December 2022, representing a 40x growth in less than 2.5 years. So the right-hand chart shows this visually with our installed hash rate tracking a 361% cumulative average growth rate since December 2022. Simply a testament to our team's execution capabilities. So we're now on the final leg towards this 50 exahash target. The data centers, phase 5 of our Childress campus, an additional 150 megawatts of capacity is nearing completion. The primary substation is already on site and nearing energisation, so that's the 138 to 34.5 kV transformation. And then the bulk substation, we've completed the key upgrades, and a second 345 kV to 138 kV, so this is the high voltage substation, is scheduled for delivery imminently. So this is important because not only does it support the full 750 megawatt deployment, but it also creates and provides some additional redundancy as we head into alternate applications for this site, which we'll come on to later in the presentation. In terms of miners, all the hardware is procured. It's been secured for a little while. It's now scheduled for shipping from Southeast Asia and is scheduled to land well within the 90-day tariff pause for reciprocal duties. So that's a bit of a win. At full 50 exahash deployment, current market conditions, as you can see in that table, based on a $95,000 Bitcoin price at least, supports $588 million in illustrative adjusted EBITDA. The table at the bottom right walks through this. So at 40 exahash where we are today, we estimate adjusted EBITDA of around $450 million, already delivering a 60% margin. At 50 exahash, given the unit economics, driven by scale efficiencies, that fixed cost leverage, that rises to $588 million and a 62% margin. So these aren't projections. Clearly, we don't know where Bitcoin price will be, but they do illustrate the underlying profitability of our mining business and some of the resilience going forward. So at this point, yes, we have made a deliberate decision, despite all this, to pause expansion beyond 50 exahash, even though we had originally contemplated the 52 exahash. The reason for this decision, firstly, it saves us around $43 million of near-term hardware capex. Secondly, it allows us to reallocate capital and internal resources, importantly, towards liquid cool AI data centers. And finally, we still preserve that strategic flexibility depending on Bitcoin price, depending on network difficulty, depending on unit economics to resume this growth in the future. But for right now, we've built out scale and we're now switching our focus to maximizing return on invested capital. And we see the best opportunity to do that in the AI vertical in the near term. So we're now one of the largest and lowest cost Bitcoin miners globally. That positions us with meaningful and consistent cash flows, which is particularly valuable in capital intensive sectors like AI infrastructure. So our ability to generate that cash allows us to self-fund some of the high margin, high growth verticals, such as AI cloud, such as AI liquid cooled data centers, and allow us to minimize dilution for shareholders going forward. So we're delivering scale, we're controlling costs, and we're using this platform to drive the next phase of our growth in AI infrastructure. So this is what makes 50 exahash clearly not a stopping point or an end point, but a great place for us to pause and really drive growth in a new vertical. Now over to Kent to talk about one of those verticals.
Thanks, Dan. As Dan alluded to, our AI cloud service is one of two AI verticals that we're scaling today and demonstrates our ability to develop and scale AI infrastructure quickly, which is critical to our success in such an agile market. For context, we launched our AI cloud service, or IREN Cloud as it's now known, as a proof of concept back in August 2023 to support our broader AI infrastructure ambitions. Our initial deployment began with 248 NVIDIA H100 GPUs in early 2024 and scaled to 1,896 H100 and H200 GPUs, all within less than 12 months. Today, the platform is supporting both training and inference workloads for a range of AI native customers on both a reserved and on-demand basis. All of this was enabled by the versatility of our proprietary data center design and delivery capabilities. The GPUs for IREN Cloud were installed in our 50 megawatt data center in Prince George, British Columbia, which had solely been operating Bitcoin mining workloads up to that point. The transition from ASICs to GPUs took just 6 to 8 weeks with minimal incremental capex. This flexibility to easily pivot between Bitcoin and AI workloads with speed is one of the major factors giving us a competitive edge in the industry. We're able to respond extremely rapidly to shifts in market demand and rapid GPU cycles. Importantly, while the Prince George site is supporting AI-cooled GPUs today, it also has flexibility to accommodate liquid-cooled configurations in the future, giving us versatility for both current-gen and next-gen GPUs should we expand deployments further. In terms of our expertise, scaling infrastructure is one thing, doing it reliably and repeatedly is another. And that's why we've invested and continuing to invest in a growing in-house AI infrastructure team across North America. From network architects, InfiniBand engineers, cybersecurity specialists, DevOps, and cloud go-to-market teams, we've assembled a team with significant depth and range. And these aren't third-party contractors. This is all internal talent that we're scaling along with the platform. Additionally, we built strong direct relationships with key ecosystem partners. NVIDIA for GPUs and networking, Dell, Lenovo, and Supermicro for servers and hardware, Intel for CPUs, and Weka for high-performance storage solutions. These relationships are foundational to how we scale, not just through procurement, but through roadmap alignment and co-design. The image that you can see on the right here shows our Prince George facility in action. It's one of the few real-world deployments where Bitcoin and AI workloads are operating side by side, connected using shared infrastructure, but independently optimized. So IREN Cloud gives us a unique edge. It gives us a proven ability to deliver real AI infrastructure, not just plan it. It provides internal expertise for deploying, operating, and optimizing this infrastructure. And it's these capabilities that we're now scaling up at Horizon 1 and Sweetwater. Moving to the next slide, we saw increased customer engagement during the quarter within our AI cloud services business. And today, our GPU fleet is running at or near full utilization with new contract wins post-quarter end. We're seeing a mix of on-demand and multi-year terms ranging from short-term flexibility up to 3-year commitments. Perhaps most exciting for us, we're now supplying white label compute to leading US AI cloud providers, supporting both training and inference workloads. This validates both the technical quality of our infrastructure and the depth of our engineering and operations team's experience, and is also proving to help strengthen our AI co-location pipeline. At Prince George, we still have an additional 47 megawatts of air-cooled capacity. That's enough to support over 20,000 NVIDIA B200s, which are currently in high demand for inference scale workloads. We're in active dialogue with customers around these deployments and continue to evaluate opportunities, including by deploying small clusters of latest generation GPUs for internal and customer testing. All of this activity sits within an investment framework focused on risk-adjusted returns. We're optimizing the sources and uses of capital and view debt and GPU financing as a very realistic path to scale. On the right-hand side here, you can see 33% quarter-on-quarter revenue growth in our AI cloud segment, building on the foundation that we established with IREN Cloud last year. Our 97% hardware profit margins, which reflect revenue less electricity costs, highlight the strong margins that we're able to achieve via our vertical integration and ownership of our data centers. The photo below from Prince George, where our GPU and ASIC halls operate side by side, shows the modularity and flexibility of our infrastructure model. So we're not just building this infrastructure, we're actively monetizing it, and we're doing it efficiently with our own data centers and reinvestment of cash flows from Bitcoin mining. This is what sets us apart in the current market and provides a solid foundation for our entry into the AI data center market. And I'll pass back to Dan for more detail.
Thanks, Kent. So that talked about AI cloud. Now I'm going to talk a little bit about the infrastructure and the co-location opportunity specifically behind that. So what we're showing on this slide is the fundamental, I guess, why behind our pursuit and our focus of AI infrastructure. So I think it's clear that the demand profile for AI compute is unlike anything that we've seen before across broader infrastructure. And I don't think it's exactly speculative anymore, particularly given what we're seeing in the market. And what we're seeing is this shift is happening fast and it's really becoming at scale. And what we're seeing is the markets are simply not ready to serve it. So I'll come on to that a little bit more, but if we look at the left-hand side, forecast global AI users, starting with the demand side, it's projected to triple from 346 million to over 950 million in the next 5 years. And this growth is not driven just by consumers, like it's all on ChatGPT, but also by enterprises embedding LLMs and other AI tools into everyday use. And everything from medical imaging to call centers to software developments. The expansion of this user base ultimately leads directly to compute growth. And as we see inference workloads scale in production environments, they require persistent infrastructure, not just burst compute for trading, which what brings us to what's on the right-hand side of the slide. So here we show that user growth translates to global AI data center demand expected to grow 3.5 times in the next 5 years. So that sounds like a big number, but what's even bigger, if you understand energy market and the scale of what this really represents in terms of real world infrastructure, 44 gigawatts today to 156 gigawatts in 2030. So that's more than 100 gigawatts of new infrastructure required globally. And today's traditional data center players simply aren't set up to deliver that at the required scale, speed, or density. So our 2.9 gigawatts that we've secured, that we've worked really hard over the last 6 years to secure, it's a big number. We all know it's a really, really big number, but in the context of 100 gigawatts, it's still small. So it sets us up for a really interesting few years ahead. So meeting this demand requires a fundamentally new class of infrastructure. So new designs, rack densities for AI have jumped 225% year on year and continue to look like they're going to climb. Traditional data center designs simply do not work anymore. They're faster construction cycles. So customers want sites built in 9 to 12 months, not 2 to 3 years. So that's really forcing a rethink of how infrastructure is designed and delivered in this sector. And we're seeing scale. The industry is now talking about 50 to 1,000 megawatt clusters, with customers asking for 250 megawatts or more across multi-year rollouts. All of this is happening live time, and the scale and the intensity just continues to climb month on month. So grid connectivity, this is really a gating factor. A greenfield hyperscale site can take up to 5 to 7 years just to secure that transmission access and energization. So that is the critical bottleneck. And it's where we clearly believe IREN has a competitive advantage, along with a few other points which we'll get to. So we are clearly well positioned to meet this demand. We've got 2.9 megawatts of secured power capacity already contracted, including those large scale grid connections at Childress and Sweetwater. We own our own land, which means we're not reliant on M&A. We're not reliant on third-party developers, and we can move quickly when customer demand materializes and is contracted and importantly, retain the upside on the infrastructure development. So I guess my message here is the demand is real. It's growing more and more real week by week, and it's infrastructure constrained. We've got the land, we've got the power, and importantly, we've got the engineering and the execution capabilities to capture a good share of this growth, and we're making it happen right now. So if we zoom out briefly and look at how we are positioned to address one of these biggest barriers to adoption, so it's not just about the GPUs, it's about the ability to deploy those GPUs with power, cooling, permitting, and speed, and that's where most of the market is getting stuck today. So we've spent years assembling the fundamental and foundational ingredients for this. We've secured those large-scale sites that I mentioned. They're very quickly becoming strategic emerging AI hubs, particularly in West Texas. We've got a track record in high-density data center delivery going back to 2018. This is not our first rodeo. We have been doing power-dense data centers for 7 years. Those of you who have followed us for that time understand that, yes, we had origins and our roots in Bitcoin mining, but we never went down the path of CCANs, old abandoned warehouses, shipping containers. We built multifunctional data centers from day one. And a testament to that, again, I'll repeat it. In Prince George, in the same data center we originally built, we have Bitcoin mining racks operating right next to latest generation NVIDIA GPUs servicing AI customers, the exact same data centers. So this experience in engineering, designing, deploying, and then operating power-dense data centers is what our business was set up to do, and it's part of our foundation. We're continuing to do it. The only difference is we're continuing to iterate on that power-dense design to service these future workloads. So that in-house development and procurement team is critical. It gives us a direct control over the project pacing. It reduces reliance on third parties. We don't need to sign big contracts with third parties and outsource all of this. It de-risks those execution timelines. But critically, we still work with tier one engineering, tier one OEM, tier one EPCM partners where it makes sense, and they're already engaged on Horizon and the Sweetwater projects. So all of this is what allows us to move with certainty, compress timelines, and meet the most demanding specs, whether it's 200 kilowatt racks, whether it's liquid cooling or multi-100 megawatt campuses. And today we've got 2.9 gigawatts of aggregate power capacity across those sites to service it. So I guess my message here is simple. We're not just a site developer. We haven't just signed simply options on land and gotten lucky around this power. We're a builder, we're an operator. We've been doing this for 7 years. We've structured the company to scale infrastructure in the power dense HPC space simply as fast as customers can commit. So while the demand is clearly global, supply is constrained, and we've got the power, we've got the partners, we've got the execution track record to meet that demand at scale. So the next major milestone in our infrastructure rollout is Horizon 1, 50 megawatts of liquid cooled AI data centers in Childress, which is currently under development and due for delivery in Q4 this year. So as we've mentioned, there's a growing scarcity of sites capable of supporting liquid cooled GPUs at scale. So this is specifically designed to cater to NVIDIA's Blackwell platform, but also beyond, with rack density of 200 kilowatts per rack. So this aligns with the next generation of model training, and customer interest has well exceeded the initial 50 megawatt data center. We've got multiple customers actively engaged in due diligence, actively engaged in commercial negotiations. So it is clear that there is a clear gap in the market, and we're looking to fill it. So in terms of the specs, just to recap, it's 50 megawatts approximately of IT load for phase one. We're designing it for 200 kilowatts of rack density, and to put that in perspective, that's compared to only 130 kilowatt for the new generation Blackwells that have been released over the course of this year. We've got full UPS and diesel backup systems, sub 6 millisecond round trip latency to Dallas, which supports both AI training along with latency sensitive inference workloads. And finally, forecast CapEx unchanged, $6 to $7 million per megawatt of IT load, which we continue to gain conviction is very competitive for liquid cooled data center deployments in the current market. So clearly securing an anchor customer for Horizon 1 is a top priority. It catalyzes our formal entry into the AI data center co-location market, and importantly, builds confidence for the broader site development opportunity across the full 750 megawatts available at Childress. It also further differentiates us in the market as we prepare to bring Sweetwater online in April 2026 and the 1.4 gigawatts immediately available at that point. In terms of financing, we're actively exploring pathways that optimize for capital efficiency. So that includes customer prepayments, project level debt, corporate level debt, equipment leasing, and convertibles. So we're also open to joint ventures, particularly with infrastructure capital providers, as long as they're aligned with our long-term control strategy. So in terms of milestones, the project's progressing along a well-defined delivery schedule. It's on track. So we're looking to start earthworks and grading in the coming weeks. In the third quarter, we'll start preparing structure, cooling, and the electrical system. And then in Q4, we expect final delivery and readiness for occupancy. So long lead items already ordered. Procurement team's very active. We remain on track to deliver Horizon 1 on the original schedule that we outlined. So Horizon 1's our first at-scale AI data center, and it's also the model for how we can potentially develop and scale across our broader platform, including Sweetwater. So we've locked it all in. Now it's a matter of executing over the coming months. So this slide brings the focus back to the 750 megawatts at Childress and our roadmap for potentially transforming this entire site into a world-class liquid-cooled AI campus. So the three main things to take away. Firstly, customer interest, as I mentioned, already exceeds the Horizon 1's initial 50 megawatt capacity. This just validates and reinforces our decision to invest ahead of the curve and make the commitment to build out this capacity, and also reinforces why we've already begun work on expanding capacity across the broad campus. Site design is now underway for a full 750 megawatt transformation. So this is not just additional racks, it's a complete reconfiguration of the site for liquid-cooled AI workloads, associated upgrades to power redundancy, cooling infrastructure, network architecture. Thirdly, we're future-proofing. As I mentioned before, 200 kilowatt rack densities as compared to the 130 kilowatts required for Blackwells, well above what we're expected to require for the next generation, setting us apart from traditional data centers even further that are really struggling to handle this basic level of density. So I think the quote here captures the design philosophy. So the project's not being engineered just for what we need now and what we need over the next 6 to 12 months, both based on the roadmap we're seeing on the GPU side, but what we think AI will demand next. So we're not just catching up, we're building ahead of the curve, and this is a real step change in capability in what we're offering the market. Top right, you can see a real photo of the Childress site as of April, clearly very active, nearing completion of multiple new buildings. And below that is a rendering of the 750 megawatt Horizon concept, illustrating how the site might be evolved to accommodate 750 megawatts of liquid cooling, high rack density, and AI specific workloads. So in context, we own the land, we own the substation, the infrastructure, we're building to rack level specifications required by future workloads, not just what fits today, and it positions us, Horizon, and Childress to be one of the few potential large-scale liquid-cooled AI campuses in North America. So this is the blueprint, not just for Childress, but also for Sweetwater and how we can potentially scale our broader platform to meet this rising demand. So Sweetwater is our flagship AI site, which we've mentioned for the last year or so now, and it's a very rare combination of secured land, grid-scale power, and site readiness that is well in motion. So to recap some of the fundamentals, 1,800 acres with up to 2 gigawatts of high voltage power capacity already secured through binding contractual agreements. That's enough capacity to support over 700,000 next generation GPUs, including those liquid cooled Blackwell GB200s. Substation, site level civil works are already well underway. So we're not waiting on paperwork, we're not waiting on anything else. We're actively building this at the moment and preparing the site for construction. So it does feel like we might be entering a super cycle of AI infrastructure build out, particularly when you look at these forecasts of 125 gigawatts, not megawatts, of AI data center capacity over the next 5 years, over $5 trillion of capital, compute, energy, land, cooling, networking. And this is where Sweetwater stands out. Most of that demand is bottlenecked by land use, zoning, grid connection, politics, and at Sweetwater, we've solved for those constraints. So the site has the potential to support up to $70 billion in end user AI infrastructure investment. $70 billion. That's the development site that we've been actively incubating and are preparing. So the initial energization is targeted for April next year. All long lead substation equipment's on order. The looped fiber connection between Sweetwater 1 of 1.4 gigawatts and Sweetwater 2 of 600 megawatts is already designed. And flexibility to scale in 1 to 500 megawatt increments gives us a lot of agility to align CapEx with customer commitments and the discussions that we're having. So there are very few sites in North America or even globally with this unique combination of scale, power, land, control, and readiness. We own the land, we've secured the interconnect, and we've started the site readiness. We believe Sweetwater is one of the most advanced and actionable AI campus in development today. So with Horizon leading our first delivery and Sweetwater anchoring our medium-term growth pipeline, we really believe we're well positioned to meet this market momentum in AI. Over to Kent now to touch on CapEx and funding.
Thanks. This next slide outlines how we're funding growth, and in particular, how our business model provides a unique combination of internal cash flow and external funding flexibility. As of April 30, we had $160 million in cash on the balance sheet. This, combined with strong cash flows from Bitcoin mining and our AI cloud, provides significant funding support for our next phase of growth. We estimate a net funding requirement of up to $250 million over the remainder of 2025, primarily to support the expansion to 50 exahash, which is already nearly complete, delivery of Horizon 1, our first liquid-cooled AI data center, targeting energization in Q4 2025, and substation development and site preparation at Sweetwater to prepare for energization in April 2026. In terms of capital markets, we've engaged advisors across multiple debt financing work streams, and we expect execution in the coming months as markets continue to stabilize. The important point here is we're not reliant on equity issuance to grow. We have a strong balance sheet, significant tangible assets, cash generating operations, and access to diversified capital channels. This capital strategy gives us flexibility to continue scaling AI infrastructure and maximize returns from the platform that we've built. In terms of illustrative cash flows, the table below shows illustrative annualized adjusted EBITDA outputs under various Bitcoin price assumptions, holding other inputs constant. At the current total network hash rate and a $95,000 Bitcoin price, we show $942 million in mining revenue. After subtracting power, OPEX, REX, and layering in our AI cloud contribution of $28 million, we arrive at a $616 million adjusted EBITDA figure. You can also see that even at lower prices, for example, $60,000 Bitcoin, we still deliver nearly 270 million in adjusted EBITDA. This is thanks to our low cost power, lean cost structure, and best in class hardware efficiency to help smooth that exposure. I'll now pass over to Belinda to walk through the financial results.
Good morning to those in Sydney and good afternoon to those in North America. Thank you for joining us for our Q3 FY25 earnings update. As Dan mentioned at the start of the presentation, during the quarter, we reported consecutive quarters of profit after tax of 24.2 million for Q3 and 18.9 million for Q2. We delivered record mining revenue of 141.2 million and recorded record adjusted EBITDA of 83.3 million and EBITDA of 82.7 million. The average operating hash rate increased by 30% from 22.6 exahash to 29.4 exahash, and we mined 1514 Bitcoin at an average realized price of 93.3K. During the quarter, the total net electricity cost increased by 30% from 28.9 million to 36.5 million, in line with the increased megawatt usage at Childress. During the quarter, the power prices remained relatively flat at 3.6 cents per kilowatt hour. The average net electricity cost per Bitcoin mined was 24K. Other costs of 25.3 million remained relatively flat despite a business today that continues to deliver significant growth and continues to support the projected continued expansion across our AI vertical, as well as the costs associated with regulatory and compliance obligations. Moving to our cash flows, I wanted to note that our consolidated cash flow statements are now presented in line with IFRS, requiring the proceeds from the sale of Bitcoin mined to be classified as cash flow from investing activities. As such, IREN filed a 20FA on March 20 of this year for the period ended 30 June 2024, along with a 6KA for the previous 2 quarters of this financial year, restating its cash flows to reflect this. The closing cash at bank at 31st of March 2025 was 184.3 million, with receipts from Bitcoin mining activities of 141.2 and AI cloud services of 3.8 million. We had a decrease in cash flow used in operating activities of 11.6 million, which was primarily due to a decrease in our annual insurance payments of 9 million that was made in Q2. We had an increase in net cash used in investing activities of 234.8 million, primarily due to significant milestone payments made on mining hardware. We had a decrease in net cash from financing activities of 349.9 million, primarily due to the net proceeds from the convertible notes that were received in Q2. During the second quarter, via the ATM, the company issued 10 million shares for gross proceeds of 110.9 million. And since the balance sheet, we've issued a further 17.4 million for gross proceeds of 107.6 million. Moving to the balance sheet. As at 31st of March 2025, the total assets recognised were 2 billion, including property, plant and equipment of 1.6 billion, which provides a strong balance sheet to support future growth. In relation to the 440 million convertible note issued on the 6th of December 2024, in accordance with IFRS, we reported a current liability of 346.2 million, including an embedded derivative of 23.7 million, and a current asset of 11.7 million for the capped call, and a non-current asset of 34.7 million in relation to the prepaid forward that would entered into concurrently with the convertible note. As IREN transitions to US GAAP reporting from 1 July 2025, the accounting for the convertible notes, capped call, and prepaid forward will be reassessed in line with applicable accounting standards. Total equity increased to 1.4 billion, with 10 million shares sold under the ATM during the quarter. So I'll now hand back over to Mike to commence the Q&A.
Thank you. As a reminder, to ask a question, please press star 11 on your telephone and wait for your name to be announced. To withdraw your question, please press star 11 again. One moment for questions. Our first question comes from Nick Giles with B. Riley Securities. You may proceed.
Thanks, operator, and good afternoon, everyone. Thanks for.
All right, guys, we're not going to listen to the Q&A. I really want to know what their guidance is. Obviously, there's some analyst forecasts here, but I really want to know what the company is guiding for. I'm a little bit confused by this. They had. Oh no, this is not revenue. This is earnings. Yeah, let me look at that again. This is profit loss after income tax expense for the period. So this is the EBITDA. So I'm not exactly sure why Macro Trends is not showing a profitable net and EBITDA margin, because they literally are positive. Like, it's just like not properly calculating it. or something. Let's see if Yahoo Finance has let's see if it has margins on here. Balance sheet, income, gross profit, net margin. So yeah, it's still got a negative trailing 12 months because obviously Q1 for fiscal year 25 and then Q4 for fiscal year 24 were negative, and that's included in the trailing. But obviously you see here operating net income, or no, we need to go further down. Net income, EBITDA margin, trailing 12 months. Maybe this is not the best way to look at it. Let's see. Okay, so revenue, gross profit, non-operating interest. No, we don't want that. Pre-tax income. I mean, this is saying it's negative, but I'm literally looking at the shareholder letter, and it's saying they had positive EBITDA and positive net. So is this non-GAAP or what? Is this non-GAAP and macro trends is using GAAP or what? Something's fishy here. Balance sheet. Q3 versus Q2. Yeah, so they're saying they have profit after, would be net profit. Okay, so I don't know why these things are showing negative when their shareholder letter is clearly showing that they made net income. So not exactly sure. I would trust their shareholder letter over these, sites that just kind of populate the information. So not exactly sure what is up with that. Here, let me see if I can try fiscal.ai, if that works a bit better. I don't have a subscription to this, but I have a free trial right now, so we'll see if we can get a bit better information on IREN on here. Unless we're getting the wrong IREN or something. I mean, I don't think there's multiple ones. This is the right one, right stock price, financials. We basically want margin, because I need to know the margin. Let's see, net income. So yeah, this is also saying it's negative. Like, I don't understand. Like, it's not negative according to their letter. EBITDA. Okay, so the EBITDA, this one's actually showing their EBITDA profitable, finally. So I don't know, like, literally this is saying their trailing 12-month EBITDA. Okay, that's why it's TTM, not quarter over quarter. This is trailing. I see. Okay, I finally figured it out. Sorry about that, guys. Yeah, let's just see if we can get, here we go, net income, year-over-year quarterly growth. I see. Okay, so yeah, it's not giving us the margin for the quarter, but we can see now finally that we have positive accordingly, yeah, which is in line with what the shareholder letter says. So unfortunately, we are not seeing margin. I can calculate it out. So we have 24 million in profit, and what was our revenue? Revenue for the quarter. Okay, so we have 24 million divided by 148 million in revenue. So if that's right, that's 16% net margin, which is actually not bad at all, especially just getting into profitability. Let me make sure I did it the right way. 148 divided by 24. No, okay. Yeah, so 24 divided by 148. 16%. So this is, wow. Okay, so they have 16% margin, net margin. Margin for Q3. This is Q3 for fiscal year 2025, which was just this last earnings seasons. Okay, I think we could probably, I want to see what revenue growth is. So revenue, year-over-year quarterly growth. So, I mean, they're growing pretty crazy quickly. Lowest quarter, 58% here, 179%, 174%. Analyst expectations for full year 2025 is 165%. And then for 2027 is about 70-80%. And we'll just kind of start to discount the growth rate forward. And I think that will be pretty dang conservatively, because I don't know, like once they finish Horizon, I mean, revenue could jump again by a massive percentage, like 100%. I don't know how profitable these data centers are. Fortunately, they didn't talk about that too much. Again, this is why I would love to have some guidance from management. So, but anyways, we're gonna throw this back on this side, pull this back over, get this up, and now we're gonna start forecasting. So this seems to be the thing you guys like a bit more. So explanation. So revenue. What are we doing here? We are probably doing this based off of analyst expectations. Is that what we're referencing? Forward revenue growth 1 year, 160. So that is actually not analysts, because analysts are expecting even more. So let's keep it in line with analyst expectations. I think that's probably pretty safe to do so. So, I mean, if they actually grow revenue by 165% this next year, which, I mean, not that crazy looking back. Like, they've consistently grown revenue by, like, crazy percentages. So, they could jump revenue from 372 million to 986 million. So, they're going to almost jump up to $1 billion based on analysts' growth in Bitcoin mining and AI data centers. So I think that's probably pretty realistic. If we go back to Yahoo, analysts thinks the year-end 2027 revenue is going to be 73%. So I think we could definitely see something maybe in the 40% range for 2026 through 2030. But let's be conservative. Let's say they're going to average 35%. This is not where that goes. 35% from 2026 through 2030. 2030. There we go. Okay, let me just pull up a compound interest calculator. Alrighty, so we are starting with basically 1 billion. We'll just round up. So 1 billion in revenue for 4 years, growing at 35%, which this could be very conservative. This company has been growing revenue very, very aggressively, but obviously that's not super sustainable. Like you can't just like, there's a lot of large numbers where it just becomes harder and harder to keep that kind of growth rate. Okay. So we could see in 2030 revenue of 3 billion 300 million. 3 billion 300 million. Wow, that would be absolutely incredible. Like, that's some crazy scaling. Yeah, so hopping on the AI trend, that is 100% possible. So this is when it starts to become very, very hypothetical. I mean, this becomes a lot harder to do. I think management is very, very capable. And we continue to see the TAM for inference continue to explode. We got TAM earlier from Perplexity, total addressable market. Where did we put that? TAM. Okay. So, I mean, by 2030, inference could be 254%, which is 20% CAGR. And then that's another double to 2035, and then multi-trillion. So, I mean, that could be another, 4x by 2040. So let's do a CAGR calculator to kind of get a CAGR calculator. if this TAM growth is correct, and we'll just assume that IREN is able to scale linearly with AI data center requirements, AI factory requirements, which I think it's probably possible that they are able to scale revenues non-linearly with the growth. So if we start at 106 billion and we grow to, let's say, multi-trillion, so it'd be at least 2,000 billion. Oh wait, no. This goes into this field, and this is over 20 periods because this is 20 years. That is a 15%. Okay, so let's be conservative. We'll assume they continue to grow, and this is assuming they don't keep putting more money into Bitcoin mining. I think they could probably grow at 15% out 10 and 20 years. So this will kind of be their so from 2030 to 2035, and then from 2035 to 2045, continue to grow at a 45% or 15%, not 45%. Oh my gosh, I'd love if they were able to grow at 45%. All right, so let's go back to the compound interest calculator. So we are starting in 2030 with 3,300,000,000. We're going to scale this over 5 years at 15%. And again, I think this could be like conservative. Like, I think you could build a bull case where IREN is able to execute far better than this. But I think this is maybe a pretty reasonable base case for IREN if they continue to like hyperscale with AI factory build out. So you could see them with 6.637 billion dollars in revenue in 2035. And I forgot to change this. Okay, ready, a dollar amount, perfect. And if they're able to continue to execute, again, this is just my best estimate. I mean, this is definitely more of an art than a science. This is just them growing with the growth of basically AI factory requirements. So could be different. Obviously, the estimate of how much AI factories will grow is also just an estimate. It's like impossible to predict the future, but we're just trying to build out like a reasonable scenario, basically, where we think that the management is able to execute fairly well and take advantage of this AI data center build out, or pivot to the next big thing, which is another thing where I think, based on the past execution of this company, they're growing revenue. I don't think they've had a single quarter where they have grown revenue less than 50, or well, I guess these starting quarters back here, but excluding these 2 quarters right after they went public. So since Q1 2024 for them, fiscal year 2024, they've been able to grow at above 58% every single year. So year over year, any year over year period, growing at over 50%. So pretty incredible. I think it is pretty realistic. I mean, this is not a super massive company, so being able to grow revenue consistently is definitely possible. So 26,850,000,000 in revenue in 20 years, 15% CAGR of inference / AI data center demand. So, oh, that's not right. Undo that. Okay, so profit margin in year 1. So this last quarter, we just calculated it out. They had profit margin of about 16% net, and that's for this last quarter. We can calculate what their margin was in the quarter before. Let's look at that. Yeah. We don't need this compound anymore. We don't need that. We shouldn't need either of these tabs either. Okay, so let's look at revenue for this quarter. So this was Q2 fiscal year 2025. They had trailing 12 months, $120 billion of revenue and 18 million of earnings. So 18 million divided by 120 million is a 15% net margin. So 15% net margin for Q2 fiscal year 2025. So they are slowly growing margins. I wouldn't be too surprised if this fluctuates quite a bit in the short term. I haven't given, let's ask Perplexity, what revenue and net margin guidance has IREN management given, if any? Make sure we correct our spelling. All right, let's see what Perplexity says. Net profit after tax, 28% growth quarter over quarter, so falling a little bit from the quarter before, 33%. So this is for the next quarter, March. Oh, this is the results. No. Monthly update. Let's see, May 2025 monthly update. Record monthly revenue and hardware profit. Daily hardware profit of 1.6 million. So are they saying, so this is May, this is after the end of the last quarter. I don't know if that's net profit or what, earnings. 1.6, there's about 90 days in a quarter. I mean, that would be a massive jump in earnings. I don't think that's quite right. Margins, hardware profit margins in the AI segment are reported at 97%. I mean, that's got to be gross margins. Very strong profitability. I don't think Perplexity really understood my question here. Overall net margin for the recent quarter was approximately, yep, that's what we calculated. EBITDA guidance for Q3 net profit. So they're guiding for the same amount of profit that we saw on that. What do you mean this is guidance? This is not guidance. That's what we already know. Yeah, okay. So it sounds like they probably haven't guided, and the Perplexity is just trying to come up with some BS, because it's just giving us fiscal year Q3 numbers, which has already been reported, and it was the earnings call we literally just listened to. So, all right, well, it's tough to say exactly what profit margins will be. They're currently 16%, so let's just assume it stays flat, because I can't really seem to find any profit margins, so let's just assume it continues to stay flat. Net margin stays the same as Q2 and Q3 of fiscal year 2025. So let's just say they say the same. I mean, this isn't the most accurate way to do this. I would have liked for, management to give us some kind of guidance for margin, but since they did not, we'll just assume they stay at about 15% net margin. Okay, so well, we got price to earnings. Earnings in 1 year. I'm gonna remove this reference because I'm not exactly sure. The forward PE on this is about 200. We'll definitely assume that starts coming down fairly rapidly. Say 50 in 5 years. If they're consistently growing at 15%, you could definitely see the earnings multiple in the high 20s. We'll say 25 and 25. Okay, perfect. So in 1 year, oh my gosh, if that's correct, that would be insane. That's saying it has the potential market cap. It's got a $3 billion market cap right now. So this is saying that IREN could potentially 10x in the next year, which is absolutely insane. And then actually goes down because the market cap kind of stays flat. Okay, so if you have a 5-year market cap lower than the, let's assume the market cap comes down, the PE kind of comes down a little bit more into a more reasonable range. That should cut it in half, which still means it could be a 5x. And then let's drop this down to 40. So we're being a bit more conservative here. And this way it won't look like a crazy, market cap in 1 year, a more reasonable market cap in 1 year. And then there's still decent growth between year 1 and 5, and then 5 and 10, and then 10 and 20. So, all right. So this is all plotted. So let's look on, okay, sweet. So we have the ROI potentials here. So it could be as much as a 4x in the next year, potentially, if our estimations are correct. Again, this is not financial advice. It's just me, some dude on the internet, making a model and seeing what the outputs are. These are 100% wrong, but hopefully directionally correct based on what we've learned about this company. So the model is saying if our numbers are correct, it could be as much as a 4x in 1 year, a 5x in 5 years, a 6x in 10 years, and a 26x in 20 years, which is really, really good. So again, keep in mind, at an 8% compound annual growth rate, the S&P 500 will double about every 7 years. So you're talking about in 1 year, that's only up 8%. In 5 years, let's say maybe it's a really good 5 years and they do double in the 5 years, that's a 2x if you just invest in the S&P 500. So you're saying you're going to well outperform the S&P 500 in 5 years. In 10 years, maybe that's like a 3.5x in the S&P 500. So you're still outperforming the S&P 500 by double. And then in 20 years out, that would be a 8x for the S&P 500. But the stock, if their management is able to execute, continue to ride the growth trends of the AI inference and factory build out, you could see this company 26 exiting, which is 8, 16, 24, 3 times better performance than the S&P 500. So the last bit of the stream, we're just going to go over this right here. Oh my gosh, look at IREN. So, oh my goodness. Yeah, according to this, there is some crazy short-term upside potential from IREN, which again is very in line with what we were looking at earlier with this EVRRG prediction, saying it's very, very cheap. So if it comes back into line with a pretty good fair price, you could see massive stock price growth on IREN. So this is why I love to model these things. You build that story, you build that conviction in your head, and then you put it into numbers, and it allows you to visualize. So I mean, you could have learn what I learned and not put into numbers, and you could have invested in IREN, and it could have been a great investment. But you don't know how that compares to other. So the biggest thing is, I think a lot of people do the story building. They get a good idea of what the stock, like which direction the stock price is moving, and they can be a good investor. But to be a great investor, I think you have to level up your game even a little bit more, put that knowledge in your head, that conviction in your head into numbers so that you can better compare. And you don't just invest in a lot of your great ideas, but you start to invest in your best ideas. And I think that's how you go from a good investor to a great investor. I think that's how you turn good returns that you beat the S&P 500 from. Because I think you can definitely beat the S&P 500 just by story investing. But if you really want to be in the league of like Peter Lynch, Warren Buffett, these crazy 30% annualized returns, you have to go to the next step. You have to do the work. You have to put that knowledge into numbers. You have to dive into the balance sheets. You have to dive into the revenue, dive into that growth, and really say, is this one of my best ideas? And then, invest according to maybe your 5, 10 best ideas. However much risk you have. Warren Buffett is like, when you're starting to put more money into your 30th best idea, like you're just way better off putting more money in, one of your top 2, 3, 4, 5, 10 top best idea stocks. So, and having that diversification, obviously, there's always a chance you're wrong. IREN stock could go down 50% over the next year. If Bitcoin price tanks, they fail building out their data centers, there are real risks to investing. And so, a lot of these big names do suggest some diversification. Peter Lynch kind of puts it where he likes to say, 5 stocks is a minimum. One stock, will do better than you expected, 3 stocks will do about how you expected, and maybe 1 stock will do much worse than you expected. And that diversification just means your portfolio will consistently still have great returns despite, you know, the occasional mistake, being wrong about something, misjudging a situation, which is, again, the stock market is, we're looking forward, we're trying to predict the future, and we're always going to be wrong. So depending on how wrong you are, I think that's probably going to be the biggest correlation. The less wrong you are, the better your returns are going to be. So, you know, you want to make sure that you're very much looking at the realities of the situation, understanding secular trends, secular directions in growth, secular directions of the economy, secular directions of society that we are traveling in, and you want to bet on those. You also want to find stocks that are underpriced. You know, be a good value investor. You know, you want to paying a decent price for a great company is what you want. You know, you want to have a great company, and you don't want to buy it for way too much, obviously, because, you know, the stock could easily go sideways for a number of years. So you want a great company at a good price, and that's kind of what we're aiming for. And from what I can tell, obviously, again, not financial advice, IREN, it seems like a very, very great company, great management, lots of history in doing what they're doing now, which is infrastructure build out, financing of these infrastructure build outs, you know, just using energy, this energy the best way they can for the best ROI, the return on their investment for energy. So, you know, sounds like the management has a really great head on their shoulders. They are jumping on a really, really bullish trend of AI that has so much room for growth, so much room for growing the company, growing revenue. So, no, I honestly, after researching this, I can pretty confidently say that I do think, again, not financial advice, there is a good likelihood that IREN could 10x. You could get a lot of hype on this stock, and you could definitely see a reasonable 10x for this stock. So, again, not financial advice. That's just my conclusion. I'm 100% wrong, but depends. Well, only time will tell to see how wrong I am, and hopefully I'm not too wrong. You know, that's what investors we aim to do. So, thank you so much for joining us, guys. I really appreciate you guys being here, spending, you know, the 4th of July with me. If you guys are in America, have a great rest of your day celebrating the 4th of July. If you're not, enjoy your Friday, or perhaps if you're already in your Saturday as well, depending on where you're joining from. So thank you for joining. I hope that you guys were entertained, and hopefully you guys learned a little bit. This is a entertainment and educational live stream. So